Hello everybody and welcome to chapter 4. In this chapter we will take a look at completing the accounting cycle. So we've gone through quite a bit of it and now we will look at the last couple of steps. So you can see here we've gone through all the way up to step 7. So we've looked at how we identify and analyze transactions. So that was our thought process. And then we record our journal entries as they happen through the month. We post those entries into the T accounts or our ledger. From that, we then prepared an unadjusted trial balance. Next, in chapter 3, we went through journalizing and posting adjusting journal entries. So where we needed to update our revenues and expenses at the end of the month. We then prepared an adjusted trial balance. So once we posted all of our adjusting entries, we updated those T accounts and created this new adjusted trial balance. We then used that to prepare the financial statements. So we prepare the income statement, statement of owner's equity, and the balance sheet. And even though number 7 or step 7 isn't the last step, our financial statements, that's the biggest report that we have. So that's the main reason we're doing all of these steps. So we can prepare statements for the users. But once those are prepared, we now need to complete steps 8 and 9, which are the closing steps. So in step 8, we'll learn about journalizing and posting closing entries. And then we prepare this final post-closing trial balance. So step 8 and 9 is what we will go through today, as well as a few other things. Okay, so the textbook in learning objective number 1 looks at preparing an accounting worksheet. We are not going to cover that at all in this course, and you will not be responsible for that. So I've been an accountant for quite a few years now, and I've never actually seen an accounting worksheet in my life. So because of that, we're not going to go through how that's used. It's just a tool that's available, but it's not necessary, so we are not going to take the time to cover that. So you're not responsible for learning objective 1 at all. Okay, learning objective 2 just kind of goes through a summary of what we've looked at. So I do suggest you just reading it to give yourself that reminder, but we're not going to go through it in the video. And now we move to learning objective 3. So this will be step 8, which is closing the revenue, expense, and the withdrawal accounts. So we're going to look at what are closing entries and how do we record them. So the ending of the accounting cycle is done by closing the accounts. At the end of each accounting period, we have balances in our T accounts and our adjusted trial balance. And those balances that relate to the balance sheet, so our assets, our liabilities, as well as our capital account, these need to be carried over from period to period. So if you think about this, our assets, liabilities, and that capital account on the balance sheet, these are at a point in time. So we have this balance in the account at the end of the year. But that doesn't just go away because the year's ended. So think about cash. Cash is an asset on the balance sheet. At the end of the year, we show on our balance sheet that there's whatever balance in cash. So let's just say $10,000. So there's a $10,000 balance. When we start the next year, the business still has that $10,000. It's not like all of a sudden it goes away just because it's a new year. No, you actually still have this amount, so it needs to be carried over from period to period. So the ending balance in cash or other assets and liabilities, that just starts the next year with that balance. So we ended on December 31st with $10,000 cash. Well, that's our opening amount for January 1st. Same idea, another example is accounts payable. So if you've got $15,000 in your accounts payable, that's what you owe to suppliers and other vendors. When the year ends, they don't just say, oh, well, your year ends, you don't need to pay us that money anymore. No, of course, you need to carry that over as well. So whatever you owe someone at the end of the year, you still owe them in the following year. So for that reason, any accounts on the balance sheet, they get carried over. Revenues, expenses, and withdrawal accounts. Now these ones actually need to be reset to 0 for the next accounting year, period. And it says here the accounting period, but really we only do this at the end of the year when you actually close accounts. So revenues and expenses, those go on the income statement, and then we use our withdrawals on the statement of owner's equity. So remember, these two statements, we are preparing for a period of time. So the income statement, let's say at the end of the year, they would show this statement for the year ended December 31st. But those revenues and expenses are just for that year. And the year is kind of the maximum that we want to show at once on one statement. So now that the year's ended, we want to start tracking the following year or the next year separately. And in order to do that, we need to what's called close or reset these revenues and expenses to 0. So we do an entry and we reset them to 0. So then when the next year starts, we start tracking revenue for the next period and expenses for the next year. But we're not just continuing on. They need to start again from 0 because the previous year is over and done with. We need to start fresh from 0. So this resetting of these accounts is called closing the accounts, and this is done through closing entries. So a lot of talking for that slide, but hopefully it makes sense. So we want to reset revenues and expenses to 0 because we just track them period by period. Whereas our balance sheet accounts, or assets and liabilities and capital, those continue on. We just need to carry forward the ending balance and use that as the opening. If you are a sports fan, I suggest taking a look at the very start of the chapter if you haven't yet. It goes through an analogy and compares the resetting of these accounts or closing the accounts to different games within a series. So it talks about the NHL playoffs, and if after each game you reset the score to 0-0, but you update the series. So after the first game it's 1-0, but the next game starts at 0-0. So that's kind of the same here. The balance sheet, that's your series score. So that just carries on game after game. Whereas revenues and expenses and withdrawals, those are things related specifically to each game. So you reset these just like you reset the score of the game to 0-0 for game 2. Okay, so we said that revenues and expenses, withdrawals, and the income summary. So we haven't talked about this yet, but you'll see this account come up. It's a new account, the income summary, that is used just in the closing process. So just in our closing entries, never at other times during the year. So these accounts are closed at the end of the year. They're reset to 0. And because of this, they are called temporary accounts. We use them temporarily and then we close them to 0. And if we need them again the next year, we would reopen them, but they're temporary because we always close them at the end of the year. Assets, liabilities, and owner's equity, or what we call the capital account. These are the ones that are not closed at the end of the year. Instead, the balances just carry over from period to period. And because of this, these are called permanent accounts. So they never get closed, they just continue on. Their ending balance at the end of the year becomes the opening at the start of the following year. Okay, so let's do a little practice on these. So there's a list of 9 accounts here. I want you to pause the video, take a look at these, go through and decide whether you think these are permanent or temporary accounts. So go through, if they're a revenue, an expense, or a withdrawal, they will be closed, so they're temporary. If it's an asset, a liability, or equity, it will continue on. They would be a permanent account. So go ahead, hit pause, try these on your own. It should only take a couple minutes. Once you've gone through them all, you can hit play again, and I will now go through the answers. So I'll take 2 seconds just in case you haven't paused. Okay, so let's go through these. So interest expense. Well, it is an expense account. That means we need to close it. So this is temporary. Salaries payable. If it's payable, it means it's due to someone else, so it's a liability. Therefore, this is a permanent account. So just because the year ends doesn't mean these employees don't expect to get paid. No, they just need to get paid in the following year. But that salaries payable balance, it just carries over. So it is a permanent account. Furniture is an asset. It's a long-term asset, part of property, plant, and equipment. This is also permanent. So again, if you think about furniture, just because the year ends, it's not like all of a sudden this furniture that you have disappears. No, it stays there. So you just carry that balance forward. Service revenue. Well, a revenue account we track just for a period of time. Therefore, once that year is ended, we need to close the revenue. So it is a temporary account. Accounts receivable is an asset. So this is permanent. We still need to collect this money even though the year ends. So we carry that balance forward. A note payable. Again, it's a payable. It's something we owe someone. So that's a liability. It is also permanent. We still need to make these payments even if the period ends. Accumulated amortization. So remember that the accumulated amortization of equipment, that's the contra asset account. So it sits with the equipment account and it is shown on the balance sheet to decrease the value in equipment. So this is also a permanent account. Amortization expense, if we had that, that would be an expense account, so it would be closed. But this is that accumulated balance that continues on year over year. De-landry withdrawals. So I've taken money out, I'm the owner, I've taken money out of the business. This is a temporary account. So the withdrawals, we track those over a period of time. So what did I take out in the year? Then I close that at the end of the year and start fresh to see what I've withdrawn in the following year. And de-landry capital, this is a permanent account. So the capital balance, that is what's owed to me or what's retained in the company and carries forward year over year. So you just continue to update this and it carries on, so it is permanent. Okay, so that's a quick look at the different types of accounts. And now we'll go over the steps that are done to actually close out these accounts. I'm actually going to skip ahead to this one first, and then the next one was just a summary. So you always do this in 4 steps. So the closing process, these are the closing entries that are done. and there's 4 of them. In the first entry, you close the revenue accounts, and you close these to what's called this new income summary account. So again, we're just creating this new account that we only use in the closing process. So revenues, the normal balance of revenue accounts is a credit, right? We typically have a credit balance in revenue. So in order to close those, you need to do the opposite. So you debit them. So you debit each of the revenue accounts for whatever their balance is. So you take a look at either the balance in the T account or the balance on the adjusted trial balance, and then you're doing the opposite. So you would debit each account for the balance, and the offset is a credit to income summary. And you only have to do that once for the total of the revenue amounts that you're closing. So step 1 is revenue, or entry number 1. Closing entry number 2, we now close all of the expense accounts, and we also put these into the income summary account. Expenses have a normal balance that is a debit, so in order to close them to 0, we need to credit each expense account. So whatever the balance is in the adjusted trial balance or the T account, you do the opposite, which will be a credit, and then the offset, because our debits need to equal our credits, is a debit to the income summary. Step 3 is now closing the income summary. So we've posted our revenues there and our expenses there, and now we figure out what is the balance in the income summary after entries 1 and 2, and we close that to the capital account. So again, you would say the owner's name, comma, capital. So if this was me, we would put it to D. Landry, capital. So now you have to actually figure out what the balance in this income summary account is after entries 1 and 2. So it might be a debit balance or it might be a credit. Whatever the balance is, you close it with the opposite in your entry. So you would either debit or credit income summary, and then whichever you did there, you would offset it to the capital account. So if there is a debit balance in the income summary after entry number 1 and 2, a debit balance, sorry guys, debit balance in income summary, and that's after you've posted number 1 and 2. This means that in the year you had a net loss. If there's a credit balance in income summary after entries number 1 and 2, that means you had net income, so a positive net income. So you can see here, with our revenues, we needed to credit the income summary. With closing our expenses, we debited the income summary. So if you end up with a debit balance, that means that this entry, your expenses, were more than the credits from your revenues. If your expenses are more than revenue, you have a net loss. If when you credited the income summary account closing your revenues, that credit was more than the debit from the expenses, that means that your revenues were higher than your expenses. You'd be left with a credit balance in income summary, which is net income. And we'll look at this when we go through an example with actual numbers, and it'll help you see that. And then entry number 4 is to close the withdrawals account. And again, we put this through the capital account. So the normal balance of withdrawals would be a debit, and therefore to close it down to 0, we need to credit the withdrawal account. And therefore our offset is a debit to capital. So the reason we put these into the capital account is because this is what we're tracking. Remember, capital, if you looked back at how we calculate or what we do on the statement of owner's equity, we start with our opening capital balance. We add in net income. So that's essentially what we're doing in step 3, because we're looking at net income or net loss. So we are now just putting it into the capital account. We're actually moving it from the revenues and expenses into capital. And in the capital calculation, so you start with opening, add net income, and you subtract the withdrawals account, and you get to the ending capital balance. So that is just what we're doing. We calculated the ending capital balance on the statement of owner's equity. Now we are actually closing the accounts and making that balance in the capital T account equal what we calculated on the statement. Okay, so here are just a summary of the 4 steps. So entry number 1, as we discussed, you close the revenues to income summary. Entry number 2, close the expenses to income summary. Number 3, close income summary to capital, and close the withdrawals account to the capital. So those are the 4 steps. If you did not have any withdrawals in the year, you just wouldn't have an entry in step 4. So if you go to a question and there's no balance in the withdrawals T account, or the withdrawals account isn't even on your adjusted trial balance, you would only have 3 entries. But if it is there, you do need to close it. Okay, so that walks through it. In the next video, I will go through an example of actually doing this process.